talk about BEPS Pillar 2, and we're with Nandeesh Mehta. Nandeesh, please can you introduce yourself?
Sure, Tim. Hi, everyone. I'm currently the head of direct tax here at Capita. So Capita are a multinational organization providing consulting, transformation, and digital services to many businesses globally. So that's just a high-level intro to myself, Tim.
Thank you so much. What is BEPS Pillar 2?
All right, so BEPS Pillar 2 is quite a big topic, especially for people in the tax industry. But at a very high level, BEPS stands for base erosion profit shifting. It's a term that's been there for a while, but essentially it's a set of rules and standards that have been set by the OECD. So OECD stands for Organization for Economic Cooperation and Development. And we've got about 130 to 140 member countries that are a part of it. And then if I come on to Pillar 2, you've got two things. Actually, it's Pillar 1 and Pillar 2, but we'll talk more about Pillar 2 here. So Pillar 2 impacts a lot of large global companies. Broadly, it's companies with a global revenue of more than 750 million, whereas Pillar 1 impacts very few super large companies, I would say, because you're looking at global worldwide revenues of 20 billion or more. So that's, I guess, a very, very high level introduction to Pillar 2, and there are sort of compliance reporting and potential cash tax consequences to think about. But one thing just to mention, I guess, for people who are new to this, is that the rules aim to establish a way of ensuring that large corporates pay a global minimum tax rate of 15%.
Okay, that's interesting. Why was this initiative launched?
So it's just another BEPS initiative. So as I was talking about BEPS and OECD earlier, they're aiming to tackle tax challenges of the digital economy. A lot of things around the world are now currently thinking about how is digital economy impacting us in our day-to-day lives, and sort of if you put tax into that conversation, then BEPS Pillar 2 immediately is the current topic of conversation. In theory, it should reduce the ability for large corporates to report higher profits in low tax jurisdictions without any commercial purpose, because you almost end up coming back to this 15% global tax rate once these rules are all effective.
Cool. How does Pillar 2 affect big companies?
That's a good question. So in many different ways, but the way I see it is I break it down into 4 different impacts. The first one is resources, because immediately with new legislation, which is such wide-ranging here and quite complex, you're thinking about more tax spend immediately. So as a CFO, you'd be thinking I'd need to allocate some budget to tackling this problem, because you need more tax people or you need more external spend, and we can talk about that in a bit more detail later. Compliance being the second one, because at some point there will be what we call a Globee return to consider, and timelines are important there. The third one is tax reporting, because if we take December year ends for an example, there are some immediate reporting considerations to think about. And then finally, the fourth leg to this, in my view, is tax liability, because where you have a differential between what I call the effective tax rates of 15% and the jurisdictional effective tax rate, where you have low tax jurisdictions, any differential will lead to some kind of a tax liability or cash tax payment to make. But again, the rules are very complex.
Sure. What are the key timelines to be mindful of?
So no, that's a very good question, because I think so many people are on this journey. It's very hard to know where you should be at this point in time. So if I think about high level timelines, taking December year end as an example, because just like where I work at Capita, we're a December year end, and if you in terms of how the rules work, you have a model set of rules that the OECD have launched and shared with everyone globally, but the countries need to bring these into law in their own sort of using their own timelines. So UK, for example, have brought it into law in 2023, but the effective date for these rules are 2024. So from 1st of Jan 2024, which is just around the corner really, there's some immediate tax reporting requirements to think about based on what I just said earlier. But in terms of a formal submission and compliance deadline, the first actual return that needs to be submitted in most cases is 18 months from the start of the rules. So if you talk about 1st of January 2024, you're talking sort of June 2025 for a full-on compliance submission. So that's just a high level indication of key timelines.
Sure. Will this tax change the price of things we buy?
So that's a good question. So if you think about tax in a slightly different way, so key taxes for corporates are, you've got direct or corporation taxes, you've got employment taxes, and then you've got indirect taxes like VAT in the UK. Now, Pillar 2 and all these rules fit into the direct stroke corporation tax bucket. So it wouldn't impact price of things we buy directly because it's not a transactional tax like VAT. But if you think about it a bit wider, it is in a way an indirect cost to an organization. You know, they need more resources, more people, maybe more software spend, a bit more time commitment. So all of that could indirectly add to the cost base of large corporations, and it may impact, you know, some of those things that you buy, but not really directly.
Sure. Why do countries want this tax?
So it's, as I was saying earlier, an OECD BEPS initiative. So, you know, governments and member countries around the world have signed up to that initiative. And in a way, it's trying to level the playing field. So it's really a global decision to tackle the challenges of the digital economy.
Sure. What are the benefits of this Pillar 2 initiative?
That's a good question. I mean, it really depends on from whose perspective you think of this as a benefit. So the rules are quite complex, right? So if I take one example, you know, if you look at a big multinational organization, like Capita, for example, where I work, you've got a UK company at the top, and then you've got lots of other companies underneath, etc. Based on the way the rules are currently drafted, there would be, you know, if there are companies and countries where you have a low tax jurisdiction, then there could be a top-up tax liability at the headquarter level. So at UK, for example, but it won't always be the top company because the rules are a bit trickier. So when you go into the details, you know, you'll realize that, you know, certain countries have enacted legislation, certain countries haven't. So at a high level, it's the top co-jurisdiction to the extent that the relevant local country hasn't really met that 15% ETR. But again, these rules are changing, they're evolving, local countries are introducing new rules. So all of this is a moving target. So you just have to keep an eye out for now. But yeah, that's I guess I wouldn't call it a benefit maybe, but yeah, some governments will get, I guess, some tax revenues out of it.
Sure. Are there any downsides to this Pillar 2 initiative?
So if I think about this from a corporation perspective, then all the companies that are in scope, and here again, we're talking about global revenues of 750 million or more, then yes, because you've got increased compliance to think about, you've got the potential increase in liability in certain low tax rate jurisdictions if you've got sort of high amounts of profits there. The rules are very complex. So again, with any complex tax and new tax legislation, you need the involvement of experts. So that's again increased spend, increased level of understanding within the organization. You have to raise awareness within the organization because it does impact not just tax, but you know, you'll have finance departments, COSEC departments, other departments that'll have to provide information to comply with this new legislation. So in a nutshell, you know, overall increased costs and compliance and resources to consider for M&Es.
Sure. Do all countries agree with Pillar 2 initiative?
Yeah, again, a good question, because if we again flip back to this whole OECD concept, you've got member countries who agreed to tackling the challenges of the digital economy, and so in a way have indirectly signed up. But then formally speaking, since the model rules came out, each country has to then legislate and bring these rules into their own country. So a lot of countries have now started signing up this year, and therefore, yes, that at a high level, you know, a lot of countries who are signing up have obviously agreed with the initiative, but not all agree. And a classic example for that is the US, which is, you know, a big country, and we all know, you know, USA is a country that a lot of other countries look up to. So that's a jurisdiction where they haven't yet enacted the Pillar 2 legislation, and so based on current rules, US multinationals will still need to consider the rules, because, you know, if you have global revenues more than 750 euro millions, you're still within the Pillar 2 rules, and maybe some other country will end up getting the top-up tax liability where there is that differential, but maybe US will change their mind and change the rules. I have no idea.
Sure, sure. How is Pillar 2 different from other taxes?
So that's going back to that high-level explanation I was talking about, you know, where you talk about taxes that impact corporations, like indirect taxes like VAT, employment taxes, and corporation taxes. So this is similar to corporation tax in a way, because you're looking at reported profits, you're looking at tax liabilities, you're trying to compare whether through a formulaic approach, whether there is a sort of top-up tax liability to pay. So yeah, rather than thinking about it as slightly different to other taxes, I would kind of think about it more as a corporation tax in a way. And in a basic scenario, as I was saying earlier, it would be the top headquarter jurisdiction that will end up getting the taxing rights if the local jurisdictions don't have those, or don't change their rules to have those.
Okay, how do companies generally feel about Pillar 2?
So in my role, I guess, so it's harder for me to answer this question, although I do have a good network of tax professionals, tax directors that I speak to now and again. And so having discussed with different tax directors at different points this year, I think everyone's thinking of this as a increased cost and increased compliance point to think about. A lot of people are also excited in the tax world, because, you know, you kind of, it's a new piece of legislation that you can look at it in two ways. But yeah, personally, I mean, I enjoy the thrill of this new legislation, because it really combines what tax technology can do with a new set of legislation like this, and combining tax legislation with technology can really help solve some problems.
Fantastic. Where can you get help to find out more about this tax?
Yeah, I mean, that's a very good question. I mean, besides Googling BEPS Pillar 2, and you'll get a lot of hits there, I would say, you know, feel free to reach out to me on LinkedIn, and I can try and help where possible, especially because, you know, I'm shortly changing jobs, to be honest. So I've got a small window where I can help other organizations. But the main thing to mention is, you know, you can join me in person at the BEPS Pillar 2 event, so where I'm speaking on the 22nd of September at Canary Wharf. There you can get and pick the combined knowledge of not just me, but other industry tax leaders, such as a partner in practice and a software solution provider. So I'm sure, Tim, you know, hopefully you'll share the registration link for the event. So that's the second way of really learning about Pillar 2 and asking questions, because you really need 3 people in a room for something like this. Someone who's in industry, someone who's in practice like a tax advisor, and then a software solution provider, because the power of that combined sort of way of tackling this problem would really put you in a good position to be able to comply with this legislation. And then finally, you know, if you already have established tax teams and tax advisors, so if you're a finance director or a finance manager, you should really start talking to your tax colleagues. And if you're already in the tax profession yourself, then you should be speaking to your tax advisors and other software solution providers, because the data required to comply with this new set of legislation is extensive if you're in the rules, and it needs a joint effort of tax teams, finance teams, COSEC teams, and a lot of other teams to be able to comply.
Thank you so much. I learned so much today, and have a nice day. Thank you.
Thanks, Tim.
Thank you. Bye-bye.
Bye.